start. So this chapter is chapter 12. That's we're on week 9 on budgetary planning. Learning objective, I'm not going to spend time on the learning objective rather than explaining what's happening with the budgeting. So budget is one of the important tools in the company because it's going to give you an idea about how you're going to acquire and how you're going to spend resources, not only financial, but non-financial resources for the period of time. So here it says it's a written statement, the management plans for the future periods, obviously always have to be for the future. It can be expressed in financial terms, but it can be expressed in non-financial terms. It doesn't have to be always financial. The resources that we have is not only financial, they're non-financial as well. It's to communicate again objective. Once you have the objective, then we can start doing the budget. It's going to help you to promote efficiency and discourage the waste. And it's a good thing for the performance evaluation as well. Now, what's the master budget? So having the budget is going to give you benefits of having a plan ahead. Also going to help you to clearly see the objectives. It can create a warning system if the problem comes. It can coordinate activities between the different sections of your business. It's going to create a management awareness of the overall operation of the company and can motivate the people to meet the objectives. Obviously, every company which have a goal and we want to reach that goal, it has to have a budget. How are we going to do this budget? By research and analysis, creating the budget that should have the realistic goals. And the budget has to be accepted by the all level of management. It can be prepared for 1 year. It can be prepared every month. It can be prepared every quarter. It can be prepared over a longer period of time. We have different type of budgets. A short budget will be the operational budget, which is again within 1 year. Capital budget is budget over 1 year. Anything related with the capital assets, which we already know the useful life of those long-term assets or capital assets is more than beyond 1 year. It can be continuous budget. Continuous budget, we're always going to have 12 months in the budget. What that means is we're going to run budget from January to December, and when January pass, we're going to add it at the end, and then we're going to have budget from February to January. When February pass, then we're going to get February at the end. Then we're going to have budget from March to February. And that's how it's going to rolling. And we're going to have that continuous 12-month budget all the time. The process of budgeting, including going over the whole process in the company. Every budget starts with sales. Remember this, the budget doesn't start with cost. First, in order to use the resources, we have to get the resources. So the first plan that we have to make is how we're going to get the resources, either financial, either non-financial. Once we get the resources, then we can think how to spend the resources and how to use the resources. But every budget, again, starts with the sales forecast. Potential sales, what the company expected, share from the industry sales, which are the factors that we need to consider. We need to consider the economical conditions, industry that you're working. We have to do market research. We have to anticipate any advertising and promotions. We have to check what was the market share last year, year before. We have to see, is there any changes in the price? Is there any changes in technology? All those things we have to consider in order to prepare to that sales budget. Again, the most important part of the budget is the starting point, which is sales. Everything starts with sales. Everything starts with the point from where we're gonna get the resources. Again, either financial, either non-financial. After that, we can think about how we're gonna spend it, or on what we're gonna spend it. So, overall process is usually all the small companies, and we're gonna assign in the big companies, we're gonna assign the budget committee, which we're gonna have that president, treasurer, chief accountants, and management personnel, and all those things. That's for the big company. For the small company, one person's gonna do everything. Usually, the father or mother. Budget. The whole process can work both ways. Can inspire the performance, or it can discourage the additional effort. It all depends how the budget was developed and administered. And each level of management should be involved in preparation of the budget. If we do that, that means we're going to have a participative budget. Means that every person in the company is involved actively of creating the plan. That's going to help us to reach our goal in the future. Participative budget, again, introduce the overall goal of the company, and that goal is spread towards the company so the management understand what they have to achieve. That's create a kind of realistic and reliable budget rather than going from the top to bottom. Top to bottom is more like a budget that you don't have anything, you don't participate in it, it's just given to you from the top management. And it's more like a mandatory. Advantages. Which are the advantages if you're doing this participative budget? We may have more accurate estimates because the lower level of management have more detailed information about the process, and they have more knowledge about the clients, and they're the one who dealing with the clients, and they know better what's happening in the company. And if we involve them in the process of creating the budget, that can increase their level of motivation. Which are disadvantages? Disadvantages it might take a lot of time to make it, because we have a lot of information to collect of a lot of people, and that takes time. The other thing is the managers can intentionally create a budgetary slack. Means that they can't create the goals or budget numbers which can be easily attained by them, and that will against the company. For example, imagine this: you're working in the car shop dealership, and your top salespeople, you ask them how many cars you can sell next year to prepare your budget for sales. Now, their bonus is directly related to the extra sales that they're making over the budget. So they perfectly know how many cars they can sell in the good year and in the bad year. So when they ask you about the number, when you ask them about the number, how many cars they're going to sell, they're going to intentionally put a lower number of cars. Why? Because they want to guarantee their bonus. So that's something that you should have to look for. Is there any numbers which are purposely given by the management, which are easily attainable, so they can get their bonuses? So, short-term and long-term budgeting. Obviously, first thing is the time. Short-term is usually 1 year. Everything over 1 year is long-term. The best time frame here is 5 years. Emphasis here, we're emphasizing on the achievement on the short period of time, where here we're focusing on the long-term goals. This one, the short term is very details, where the long term, it's just outline the framework. It's not that detailed, it's less detail. Now we're going to the master budget. And master budget has two categories: operating budget and financial budget. Operating budget and everything related to our normal operation, starting with sales, production, and sales administrative costs. Financial budget is the budget focusing primarily on the cash needs of the company and uses information from the operating budget. So let's see the structure here. Sales budget, production budget. Once we have a product, don't forget product has three costs: direct material, direct labor, manufacturing overhead. So that means we have to prepare budget for direct material, direct labor, and manufacturing overhead. Then we have to prepare the budget for the sales administrative expenses, and we have to prepare the income statement. Up to the income statement, it's called operating budget. Financing budget is the cash budget, capital expenditures, and budget balance sheet. First question today will be this: which of the following is not a reason why company should use budget? What do you think?
Operating leverage.
Yes, operating leverage. Operating leverage, what was the operating leverage? Operating leverage simply shows how increase in sales is transferred to net income. So that has nothing to do with the budget. So let's start with preparing the sales, production, and direct material budgets. The order of preparation of those budgets is: first we're going to start with the sales budget, and we're going to start with the number of units sold. Then we're going to start production budget. We're going to see how many products we need to produce in order to achieve our sales. And then we're going to start working on the direct material, direct labor, and manufacturing overhead to create the products that we need to sell. Sales budget, management using the best estimate for the sales revenue for the period, for the budget period, and can be prepared for by multiplying expected units of sales, volume time to the anticipated or projected sales price per unit. Nothing scary here. It's very straightforward. Let's say the company expecting to sales volume 3,000 units in the first quarter, with 500 units increments every following quarter. Sales price per unit is $60 per unit, and expect to remain constant for the year. Finished goods inventory at the beginning of the period is 600 units, and the target ending finished good inventory is 20% for the next quarter. So if you have to prepare the sales budget, that's how easy it is to prepare the sales budget. Now for the production budget, that's a little bit more tricky. Why? Because we always have to have ending balance. I'm going to explain this in the classroom. So you're going to see this in the classroom. And then we're going to do this question in the classroom. I'm going to leave this to have something in class. Once we prepare the production budget, then we can start working on the direct material budget. For direct material, we also want to have a beginning balance So we have to consider those ones. And then calculation direct material cost will be easy. Direct material for the units that needs to be purchased by the cost per direct material is going to give it the cost of purchase. And we're going to do this question in the classroom. So you're going to see how exactly we're going to prepare this. For that reason, I'm going to ask you to bring your laptops. Bring your laptops and we can do this in the classroom on the Excel spreadsheet. So you can see the exact process and we're going to go one after another spreadsheet, and you're going to have all the spreadsheets available for you. Make sense?
Sure.
And then we can do those questions in the classroom. After we do the direct material, now we get into the easy part, direct labor and manufacturing overhead and sales and administrative expenses. The hardest budgets are production budget and direct material budget. After that is downhill. Because in direct labor, we don't have beginning balance. We only need the units that we need to produce and direct labor hours per unit and cost per hour, and gonna give us total cost. There's nothing scary here. Manufacturing overhead, again, we're gonna split the manufacturing overhead for the variable and fixed, and we're gonna see how much is the variable portion, how much is the fixed portion, and we're gonna calculate that manufacturing overhead. And we're gonna come up with that calculation as well. Operating sales administrative expenses. Again, we need a little bit information on that. Again, we're going to have a variable portion and the fixed portion. Variable portion will be directly related to the sales. So we need those units that we're selling. And we're going to get the variable portion for the sales commission and everything else for the fixed. We're going to prepare this again in the classroom. I'm going to leave those questions in the classroom. Now the budget income statement, that will be very easy because we have the sales. The only thing that we have to get is the cost of goods sold. Cost of goods sold, we can easily calculate it from our direct material, direct labor, and manufacturing overhead. And we can come up with the cost per unit. Once we have the cost per unit, we're going to check how much is our ending inventory. How much is our production for the period of time, and we can easily calculate how much is our cost of goods sold. Once we do that, we're going to check the period expenses, which is the variable and fixed expenses, sales administrative, interest expense if there's any, and we can easily come up with a net income statement. After the net income statement comes calculation for the financial budget, which is the capital expenditures budget first, cash flow budget, and the balance sheet. The capital budget, we already talked about in the previous chapter on the capital, how we're doing those capital decisions, when we're purchasing the capital assets, when we're not purchasing the capital assets. For the cash flow statement, that will be the interesting part. Cash flow statement is probably the most important statement. And it's going to have three sections. One section is going to see cash coming in. On the other sections, we're going to see cash going out. There will be calculation, how we have a shortage or we have more cash. And the third section will be financing. If we don't have enough cash, from where we're going to get the cash, or we have extra cash, for what we can use the cash. Now the cash receipts will be anything related to sales. Also, we can get cash from the interest or dividends that we might receive. Disbursements, we have to pay for the direct material, direct labor, manufacturing overhead, sales administrative expenses, and all the other period cost. We don't care about non-cash items such as amortization and depreciations, but we have to consider any money that we're paying for the income taxes, installments, dividends, and investments. So the financing section is going to we're going to show us where we are on cash. Do we have again excess of cash or shortage? And if we have a shortage, it's going to give us idea how much to borrow. If we have excess, it's going to give us idea how much we can invest and for how long period. So cash flow budget is going to read from all the other budgets to get the numbers. The only thing that we need here is the beginning balance of the cash. Once we have the beginning of the balance of the cash, then we can start creating our cash flow budget, which we're going to do in the classroom again. First, from the sales, we're going to see how we collect the sales. Based on our collection of the sales, we can prepare the cash inflow. Then we're going to see how we're paying for different things. How we're paying for the direct material, how we're paying for the direct labor, how we're paying for how often we're paying for the sales administrative expenses, manufacturing overhead. Is there any capital purchases that we anticipated? If we have to pay the income taxes, how much we have to pay? And if we have any outstanding loans, how much we have to pay for that? And we're going to come up with that calculation, and you're going to see how exactly this one is done. Now, once we have that information, we can prepare the full cash budget that's going to look something like this. And as you can see here, we have the beginning balance, and we have the cash in, cash out, excess or available cash, how much is the balance. Every company usually have a requirement for the minimum cash that they need to have on hand. So if we don't have that cash, we have to borrow. As you can see on the second quarter, the company falls below the $15,000 requirement for cash, so they have to borrow $3,000. On the third quarter, they're going over the 15,000. So the first thing that they're doing is they repaying their debt, borrowing, and then enjoying the cash. And the fourth quarter, they're way ahead. They have $37,900 versus 15,000, so they don't need to borrow. Obviously, they don't have enough money to invest, but at least they don't need to borrow. Now here, which of the following item would never appear on the cash budget? That will be any non-cash items, and that is depreciation. Depreciation is not cash item, so depreciation never gonna happen on the cash flow budget. Then we have to do this question in the classroom, and once we do that, we are ready to prepare the balance sheet. Balance sheet's gonna read again from all the budgets that we prepared: cash budget, accounts receivable budget, finished goods inventory, raw material inventory, building equipment, accumulated amortization, everything. Once we do that, we can prepare our balance sheet. And that's how we're gonna do this budget, but we're gonna I'm gonna spend more time in classroom to do this. So you don't have to worry, we're gonna go through the whole cash flow, cash budget. Not budget, but the whole budget process, including the cash flow budget. Budgeting for the merchandising company, that will be very close to the budget of the manufacturing company. The only difference will be we're not going to have a product cost. We're going to have the cost of goods sold for the merchandising, that with the one that we buy and selling. That will be the only difference. For the service company, now the service company budget, it might look like a manufacturing company because the service company not provide not only service, but sometimes they have small items which are also part of their normal operations. So they might have similarity with manufacturing company budget. For the non-for-profit organizations, non-for-profit organization, obviously budget will be the very crucial part. As you already know, every government has that budget and prepared a budget in the beginning of the fiscal year. And that's a crucial point for the projection of the spending for the upcoming period. And for those, the budget has to be strictly followed, because not following the budget can create a deficit. And that will be the chapter today. Very briefly, very fast going over the chapter. And that's going to free us now time